Hi, Bill Lethman here from Lethman Financial. Welcome back to part 3 of our 4-part series on rethinking retirement income. This is probably my favorite video. Here I'm going to show you some of the math and science behind retirement income. There's 4 primary factors that will determine your success or failure when it comes to creating a lasting retirement income. Market returns, the sequence of those returns, inflation, and your withdrawal rate. Now, we all face one primary dilemma when it comes to deciding how to invest our retirement portfolios. On one hand, if we invest too aggressively, we run the risk that market crashes can cause us to run out of money. And on the other hand, if we invest too conservatively, we run the risk that inflation will erode our purchasing power. We have to withdraw larger and larger sums of money from our portfolios to keep up with it, causing us to run out of money. So to give you an idea about the effects of inflation, I created this example. I call it how to lose money safely, or the risk of investing too conservatively. Let's say that you had $100,000 back at the beginning of 2001. Your main goal with this money was to not lose any of it. So you decided to invest it in 1-year U.S. Treasuries, and every year when they matured, you just rolled it over into another one. Keep in mind that interest rates back then were actually not too bad, certainly better than the fractions of a percent that they're paying today. So what I wanted to do was show you the real return of this money after taxes and after inflation over a 10-year time period. So I used the actual data for Treasuries and inflation from January 2001 through December 2010. Here's what I found. Your $100,000 investment rolling over 1-year Treasuries every year after taxes grew to $123,115. And if you just stuck $100,000 under your mattress over the same time period, your $100,000 would only buy you $77,267 compared to what it would have bought back in 2001. So the value of your dollar lost about 23% of its value from 2001 to 2010. Stated differently, our money is only worth about 77% of what it was back in 2001. So if we multiply the $123,115 by 77.27%, we find that the purchasing power of that investment is only worth $95,130 compared to what it would have bought back in 2001. So we had a real loss of purchasing power of $4,869, or how to lose money safely. Over longer time periods, this can really erode your money. Okay, let's talk about how withdrawals work in retirement with another example. Mary is a very conservative investor. She's 65 years old with $1 million portfolio that she needs to withdraw $60,000 a year to meet all of her expenses. And she wants to make sure that her withdrawals keep up with inflation. Because she's very conservative, she also wants to invest in 1-year Treasuries. So how long do you think her money will last? Well, if she began in 1970, her $1 million lasted for about 13 years. If she began in 1980, a little longer at 17 years. If she had started at the beginning of 2000, she's not out of money yet, but she's down to just $374,291. After only 10 years, she has spent nearly 2/3 of her money and will likely run out of money in the next 10 years. Okay, so we talked about the risks of investing too conservatively. Now let's look at some examples of how market crashes and volatility can wreak havoc on our retirement portfolios. Now, Bob retired in 1991 with $1 million retirement portfolio and decided to invest the whole thing in the S&P 500 stock index. He needs $60,000 a year to cover his retirement expenses and wants to increase that every year by 3% to keep up with inflation. Now, from 1991 through 2010, the S&P 500 averaged 11% per year, and Bob withdrew $1,612,222, and at the end of 2010, his portfolio was $2,930,862. So he invested $1 million, withdrew over $1,600,000, and after 20 years, his portfolio had actually grown to nearly $3 million. Not a bad return. So I have a question. Is it possible to average 11% per year on your portfolio, withdraw 6% every year, and still run out of money? Let me ask it again. You earn 11, withdraw 6. First thoughts would say no, but let me show you another hypothetical example. Here, I have the exact same example as the one I just showed you with one simple change. I reversed the order of the returns. So instead of the return from 1991 being the first year, I made it the last year. And instead of the return from 2010 being the last year, I made it the first. So what did this do? Well, what do we know about the markets over this 20-year time period? Well, the 90s were one of the best decades ever for the stock market, and the 2000s were one of the worst decades ever for the stock market. So in the last example, we had a really good decade followed by a really bad decade. In this example, we reversed that and started with the bad decade and ended with a good decade. Let's look at the results. Bob invested his $1 million, took out his withdrawals every year. So we put $1 million in, took out the same $1,612,222, but instead of having nearly $3 million at the end, he's now down to $210,247. Not out of money yet, but chances are very good that he'll run out soon. So what this is called is the sequence of returns, and it can have a huge impact on your retirement success. So the average of your returns may not be as important as the sequence of those returns. Primarily, if you get more bad years at the beginning of your retirement, it can have a very negative effect that can be difficult to recover from. On the other hand, if those bad years come after a series of good years, it tends not to have as big of an impact. So what is the probability of your portfolio lasting for retirement that could potentially last 30 years or more? Or how much can you withdraw from your portfolio and still have a decent chance that your money will last you for the rest of your life? Probably one of the best studies that I've seen on this topic was done by a guy by the name of Jim Otar, who wrote a book called Unveiling the Retirement Myth. In it, he runs calculations going all the way back to 1900. He examined what if you retired in 1900, what if you retired in 1901, 1902, etc., all the way through to today. He wanted to give you an idea of how the sequence of returns and the unlucky possibility of retiring right before a series of bad years in the market could impact your chances that your portfolio could run out of money. And this is what he came up with. Going all the way back to 1900, if you kept your withdrawals to 3% of the value of your portfolio and just increased them each year by the rate of inflation, you had a 100% success rate if your portfolio was invested 40% in stocks, 60% in bonds, or the other way around, 60% stocks, 40% bonds. If you were 100% in stocks or 100% in bonds, you had some possibilities of running out of money. At a 4% withdrawal rate, you had between a 46% and a 78% chance that your money would last you for 30 years. And at 6% withdrawal rate, you had very little chance that your money would last you for 30 years. A portfolio of 100% stocks gave you the best chance at just 18%. The conclusion of his study was that an optimal withdrawal rate of 3.8% gave you a 90% chance that your money would last you for 30 years. Even though this may be considered the optimal withdrawal rate, you should consult your advisor as to the proper withdrawal rate for your situation. Now, there's two primary stages to your retirement. The first one is called the retirement accumulation stage, where your main financial objective is to have enough money to retire. Your time horizon is known. In other words, you usually know how many years you have until you want to retire. Your asset allocation is usually geared towards growth or capital appreciation. Most importantly is that market volatility may actually work to your advantage. This is because when the markets go down, you're actually buying more shares of your stocks and investments at the lower prices. So let's take a look at Jim. Jim retired in 1990 early at the age of 55. He had $100,000 that he wanted to invest in the S&P 500 without touching it for 10 years. Then his plan was to start taking withdrawals when he turned 65. Now, the 90s were one of the best decades ever for the S&P 500, and Jim's $100,000 investment grew to nearly $550,000 by the end of 1999. So, first of all, Jim is very happy. The S&P 500 actually averaged 18.56% over this time period. So now, Jim wants to begin taking withdrawals and settles in with the idea that he'll take just 4.5% each year, or $24,706, and he keeps it at that level without adjusting it for inflation. So now we're in the second phase of our retirement, the retirement income stage. Here our financial objective is to not outlive our assets. Our time horizon is unknown. We don't know how long any of us are going to be alive. The asset allocation needs to be geared towards a withdrawal strategy, and here market volatility really works against us. When the markets are down and we still need to take our withdrawals, we are essentially locking in those losses. The money is now gone and there's no way for us to recover it. So let's see how the next 10 years shakes out. Jim started in 2000 with a portfolio that had grown to almost $550,000. Now he starts his withdrawals of 4.5% or $24,706 a year. Because of the significant losses in the market in 2000, 2001, and 2002, and again in 2008, his portfolio after withdrawals is now down by over half to $247,692. So now if Jim wants to continue to take his withdrawals of $24,706 a year, he wouldn't be taking 4.5% of his portfolio, he would be taking almost 10%. And in order for his portfolio to grow at all, his account would need to earn over 10%. Now Jim is 75 years old, and sustaining those withdrawals for the rest of his life is severely in jeopardy. So to wrap up, here's some important points to remember. Your initial withdrawal rate should be 3.8% or less. Investing too conservatively can lower your chances for success due to a loss of purchasing power. The sequence of your returns may be more important than the average of your returns, and inflation may be a larger factor in your success than you think, so don't ignore it. That's it for part 3. Join me in the next video where I'll show you some tips and strategies that you can do to improve your chances for success.